some of the biggest companies on the share market have not been delivering for their shareholders.
Sky City,
Ryman Healthcare,
Fletcher's,
the warehouses,
Synlait.
There certainly has been significant wealth destruction.
So new analysis has come up with some red flags for underperforming company boards.
Well, first of all, this is not a blame game, so
No.
this is absolutely a learning exercise.
But of course,
I see that as wokeness myself.
as
but-
wokeness, not everyone agrees. Welcome to the NBR Podcast. I'm your host, Simon Shepherd. Fletcher's, Ryman Healthcare, Sky City, Synlait Milk and The Warehouse. Why do their share prices, frankly, suck? Compare each company's current share price with its all-time high, and the average drop across the five is a massive 85.8%. So, what were the warning signs?
That's really what we wanted to dig into, and with the benefit of hindsight, see if we could draw out some common themes that might be red flags that we can look for in the future.
Katie Beath was the lead analyst on this research done by investment firm Forsyth Barr.
So I guess first of all, and I guess unfortunately, we could have written quite a few more case studies
Oh,
than
could you?
5.
Unfortunately, yeah.
Unfortunately.
But you've chosen these 5.
Yeah, we had a bit of a methodology behind it.
The team looked at investment returns over 3 years. If the companies reported a loss in their last financial accounts, have they needed to fix up their balance sheet, and what debt they were carrying?
Yeah, so we sort of found 5 easily identifiable issues, and we had a range of more qualitative issues as well that rose to the surface as we sat around the table with each of the analysts that cover those companies and debated.
What did you find was the sort of like the most common theme?
Yeah, the most common theme I think that came across actually all 5 examples was where we saw evidence of weak financial discipline. So maybe companies had overpaid dividends, maybe there was rising debt, maybe there was growth spending without clear returns, maybe their plans for implementation were disconnected from the actual business cycle that we're going through.
Right. Okay.
That was the most common.
Okay, so the second most common theme, what was that?
Yeah, and this was a more qualitative one that
Okay.
kind of bubbled up as we debated things, and we saw evidence of slow recognition of in response to structural change by the boards, and that was pretty consistent across all 5 case studies. And what I mean by structural change is things like shifts in regulation, or again changes in business cycles, or maybe customer behaviour is changing, maybe fixed and input costs were changing, maybe technology was coming in as a disruptor.
Right, so a slow response to deal with the changing environment.
Yes, quite big, what we would think obvious trends that you would think a board would be talking about and working around.
So, 2 red flags down. Before we tackle the next 3, let's ask what investors might think so far.
Look, I think it's actually quite refreshing to see one of the lead brokers in New Zealand or lead wealth managers go through this process and actually go beyond the financials to some of the core governance factors that impact corporate performance.
Oliver Mander is the Chief Executive of the New Zealand Shareholders Association. I just wanted to ask this particular question before we get into the details, and that is, some of these companies have had to deal with some large external factors, disruptions, headwinds, like Fletcher's, for example, with Sky City. There's been, recession for Warehouse, or those kinds of things. Is this, looking at these particular 5 companies, is it fair to analyse them in this way?
Look, I think if you have great governance in place, then part of the role of those governors, those directors, is to ensure that the company can be resilient through whatever cycle the external economy is throwing at them. And look, all of those 5 companies have since made significant changes to their operating model and their practices. And look, that's laudable. That's to be praised.
Right.
But it's not like the warning signs weren't there prior.
What are the things that this analysis has sort of highlighted is a warning flag that companies don't adjust quickly enough or don't take into effect. They have a delayed response to these structural changes in the industry that they're operating. They're not reacting quickly enough.
From a shareholder perspective, as I said, we've been active around these companies for a while. We were calling out issues at Ryman Healthcare well prior to the very well publicised events that subsequently occurred. And for us, one of the warning flags was around revenue recognition and how they were recognised in revenue and how that was translating into the financial accounts. We were also concerned about cash disclosure. So there's a whole raft of things, and they're all just red flags.
Yep.
But it took a while for the company to react to that. If we look at Ryman again, they had a board that was, quite frankly, very set in their ways. They had some sacred cows that were in the room, and they were hanging on to those sacred cows.
And that brings us to some more red flags developed by the team at Forsyth Barr. Let's cover the next two: accounting and auditors. Here's Katie Beath again. One of these things you've identified here is like companies, a couple of them, going for a more conservative accounting practice.
Yeah.
What does that mean?
Yeah, so that means that they will have put their financial statements out with accurate figures, and then we may have seen later down the track them being restated or the numbers changed or a different way of accounting for a particular metric. And those are all, they're very strong signals, that something inside the company is not working right. And I think there's probably a link here that I would hope to delve into a little bit in the future. I haven't for this report, but whether that is linked with the auditor tenure, which is the next.
Which is the next thing to talk about, isn't it? So
Yes.
what did you find across these companies, not necessarily all of them, but some of them,
That's right,
in terms
some of
of their use of their auditors?
Yes, and this is a particular problem in New Zealand, and I think in part because of our geographic isolation and where we're located, and just being a small economy.
Yep.
That there is something in that. However, what I really worry about is when I see long-term relationships with auditors is that people really get to know each other and you get really comfortable and familiar with the company.
A comfortable relationship with the auditor, right.
And that independence, or that very objective independence, which is why we have it done in the first place, over time can sometimes soften.
In some jurisdictions, there's a practice where you are forced to rotate your auditor over that particular certain time period, like 10 years. Is that something that
in New Zealand, actually, it is legislation to rotate your audit partner after 5 years. And
After 5 years?
Yes, that is standard practice in New Zealand. I guess we're just taking it to the next level, that it's not just the audit partner rotation, but to really consider the whole company as well.
And this is where shareholders are being urged to take note. Look at the figures. Look at what the auditors say. Get involved. Ask questions. Are New Zealand investors too timid, not aggressive or educated enough to hold boards to account?
We would love to see investors take a greater interest, both in, for example, the audit reports, so particularly the key audit matters that get flagged by auditors, because we think that's a really good pointer in terms of, okay, what are the key risks surrounding a company? What has the auditor have to consider in terms of how they're looking at the company's accounts, in terms of whether those are painting a true and fair view of the company's financial statements.
Finally, it's the fifth red flag, as identified by Forsyth Barr in their study of these 5 companies: board self-review.
So standard practice is that boards should, self-review and critically assess their performance.
Yep.
But, 3 of the companies didn't undertake that process. And, I think that it's really useful for shareholders to see that, know that process is is happening anyway. It's good practice. But then secondly, if a summary of key themes or key weaknesses and strengths were identified and shared with shareholders, it would really help give us comfort that boards are functional. They're looking out ahead at the skill sets needed.
Yep.
They're assessing how they're operating, and including the chair as well.
Is there a concern that there is the current sort of setup with boards, not enough requirement for that kind of transparency and that kind of self-review?
Yeah, I guess one of my frustrations is the corporate governance data that I collect on companies shows a fairly healthy state, but in reality it's not. And we tend to follow, as what corporate governance can or at least the information I collect often lags a little bit, so we kind of follow the bad news rather than getting on the front foot. And this is what we were trying to do with this piece of research: is are there some warning signals out there that's not necessarily captured by traditional corporate governance factors that can help us just raise concerns or that gut feel that something's not right.
So here's a recap of Forsyth Barr's 5 red flags. A lack of financial discipline, not responding quickly enough to a changing environment, changing accounting practices, long-term relationships with auditors, and a lack of board self-review, including skill sets and diversity. So what do those all add up to? Have we seen quite a huge amount of sort of destruction of wealth, I guess, if investors and boards aren't paying attention to these red flags?
The short answer is yes. In terms of those 5 companies that were highlighted in the Forsyth Barr report, there certainly has been significant wealth destruction over the recent period. In the case of Fletcher Building, actually for a very, very long time. What it does highlight, though, is the long-term impact of strategic and governance decisions that get made a long time ago. So a lot of the wealth destruction at Fletcher's has occurred from decisions made back in the early 2010s and even before then. And I think that just reflects the long-term nature of governance.
At this stage, I guess we should ask someone who has been and still is a very active board member. What do they think of it all?
At a high level, I thought it was a really interesting piece of research.
Michael Stiasny is the chair of Tower Insurance, Too Cheap Cars, and has been director and fix-up guy of many others.
I was probably a little bit disappointed or didn't agree with them on the board diversity and metrics, because whilst I appreciate the importance of them, I don't think they're one of the red flags that I would make my investment decisions on.
Okay, all right. So they did, let's jump straight to that. They did talk about board skills and being transparent about the matrix of skills that was available and whether diversity was there and all those kinds of things. You don't agree with that as being a red flag if they don't have it?
No, I think we can look at some of the companies where that doesn't exist, and you would probably say they've been performing really well.
Okay.
And there are other companies on that list where they will be able to do quite well on diversity, etc. It's about the mix of people on the board, the fact that they either work together or they can debate and have conflict around decision making well, and that they have a diversity of thought, whether they are age, gender, whatever. It's nice to have. It's a logical thing to push towards an open environment, but it's not a necessity, and I wouldn't make a decision based on that.
Based on that. Okay, what about the other things that they did underline? And so one which was a common factor amongst all those 5 major companies was weak financial discipline, where they've misjudged investments or had to downgrade financials, those kinds of things. Well, that's an obvious one, is it?
Yeah, well, isn't it quite logical that the underperformers would have been in that position?
Yeah.
The real test here isn't that they have made those. Mm-hmm. It is the manner in which they make them. Have they been transparent? Yep. Have they thought about it? Did they get into the right, risk their arm for the right reason? And how did they deal with it once they had made a decision that had gone wrong? I mean, you can't have it both ways. You invest in companies because they are risky. You want to make money out of these investments, whether that's a strong dividend yield or whether it's a capital gain. It is about risk.
Yep.
If you don't want to take risk, put your money in the bank, and even if you don't want to take that risk, put it under your bed.
Yeah.
So you come to the table wanting to have someone taking risk for you, but when they take it, you hold them accountable and beat the living crap out of them. You cannot have it both ways.
Yeah.
So there is always a little bit of give and take here. Some of those companies have made too many mistakes, and that's what this is about. And the fundamentals are they have to be transparent.
Okay.
Number one.
All right. Well, let's talk about that. The issue of a lack of board self-review was another sort of flag. Now, that's transparency, is it? Or is that accountability?
I see that as wokeness myself.
As wokeness, okay. Well, okay. Well, why is that wokeness? Why is a reticence to look in the mirror wokeness?
Every board that works together will do some form of review. A review where they all say they're doing wonderfully well and they pat each other on the back doesn't tell us that the board is being as effective as possible. It tells us that they've had a chat about how well they're doing and they're doing okay.
Yeah.
So if you have a club mentality, as some boards do, then a review is going to tell you exactly what you'd expect, that it's all going great.
Yeah.
The real issue is how much money are they making? Have they done that well? Are their accounts in order, etc.? It's not about that they all got on and had a cup of tea together.
Okay. What is the key to an effective board? Is it transparency? Is it looking ahead? Is it the skill set?
So I think, and of course not everyone will agree with my view, my view is we've got to be thinking not only of this company, you've got to be thinking about the wider environment and where is the environment going. Every company needs to have a very clear strategic direction that everyone at the board table and indeed the executive team agree on. It's not fixed in stone, but it has to be agreed, and it has to be something that you can talk about and enunciate in clear terms. That's the direction. So you start with the direction. You then have to have transparency, and you have to have an accounting of cash, capital allocation, and everything else that allows you to say, are we achieving or are we moving down the road to achieve the direction we have set? That will allow you to be good or bad and to be visible about how you're going on that journey, because it's a journey and we're just simply custodians.
You've been around for a while on a few boards here and there. The current health of governance across listed companies, how would you put that?
I think we are becoming consumed, and I think this is a general feel from directors that I speak to. There's a lot of red tape, a lot of regulatory process, and I don't mean from simply the regulators. It's kind of, we're stuck in the system of make sure that we're not going to get sued, make sure that we're doing the right thing for the system per se, whether that's reporting to NZX or whatever. But come back to this fundamental simplistic thing. We're there to make money for shareholders and give them a return, and we, management and the shareholders should be talking about where is the business going, what are the risks, and is it a good place to be?
Final word then to Katie Beath, who is the lead analyst on this research from Forsyth Barr.
My hope is that it builds... Okay, well, first of all, this is not a blame game. So this is absolutely a learning exercise.
Yep.
I hope it can, from people that specialise in areas of corporate governance like I do, I hope we can try to get more on the front foot to identify risks before they play out. For boards, I think hopefully it's a great learning piece and gets them thinking about ways that they might be able to improve. And for other shareholders across the market, I hope it drives better questioning and conversations with boards, particularly and as they look to better assess how effective they are operating.
And that's it for this episode of the NBR Podcast. Any social clips used are listed in the description. And thanks to senior content producer Joseph Hisayasu. For early access to new episodes, subscribe at nbr.co.nz. Up next, the economics of weight loss wonder drugs. I'm Simon Shepherd. We'll catch you then.